Welcome to The Explainer. Today, we're diving into a fascinating theory, one that says the wild, chaotic swings of the financial markets aren't random at all. In fact, they might follow a predictable, repeating rhythm, a kind of hidden pattern driven by human psychology.
I mean, let's be honest, you look at a stock chart, and to most of us, it just looks like pure, unpredictable noise, right? A jagged line of ups and downs that seems to be pushed around by news, earnings reports, and whatever's happening in the world. But what if? What if underneath all that chaos, there was an underlying structure, a pattern that repeats itself over and over again on every single timescale?
The idea that human behavior just moves in cycles, well, it's about as old as it gets. We see it in history, we see it in fashion, in culture. Well, the theory we're looking at today suggests that this very same cyclical nature is the engine that drives all of our collective financial decisions. So who was the person who first charted this hidden rhythm? You might think it was some Wall Street guru or a PhD economist, but nope. He was a retired accountant and business consultant named R.N. Elliott, who back in the 1930s took on a pretty remarkable project. So picture this. It's the 1930s. He's 66 years old, and he has a lot of time on his hands. So what does he do? He dives headfirst into 75 years of stock market charts, looking mainly at the Dow Jones Industrial Average. And he wasn't just looking at the prices, he was hunting for a system, some kind of logic hidden inside all that data. And then he got his moment to prove it. In March of 1935, the market was looking really shaky. Most experts were terrified another crash was coming. But Elliott, using his new theory, sent this incredibly bold telegram to his stockbroker. He declared the correction was over and a huge bull market was about to start. And you know what? He was totally right. That amazing call gave his new wave principle its first real taste of the spotlight. Okay, so what exactly did he find in all those charts? Well, Elliott discovered that the market moves forward in a very specific and repetitive pattern. It's a rhythm made up of 8 distinct moves, which he simply called waves. The first part of this pattern is really the engine of the trend. Elliott called these motive waves, which is a great name, right? Because they are what motivates the market to actually move forward and make progress in the direction it's trying to go. So motive phase always unfolds in 5 waves. It kicks off with an initial push up, that's wave 1. Then you get a little pullback in wave 2. After that, the market just explodes higher in wave 3, and this is usually the longest and most powerful part of the whole sequence. After another little dip in wave 4, you get one last push higher to finish it off in wave 5. It really is like a 2 steps forward, 1 step back kind of movement. But of course, we all know trends don't just go up in a straight line forever. After that 5-wave advance, a period of either consolidation or decline has to begin, and these are what he called the corrective waves because they move against the main trend. Now, the corrective phase is usually a bit simpler. It typically unfolds in just 3 waves. You get a move down, which we label wave A, then a little bounce, sometimes called a sucker's rally, which is wave B, and finally, one last move down, wave C, and that completes the whole correction. And there you have it. You put the 5 motive waves moving up together with the 3 corrective waves moving down, and you get one complete 8-wave cycle. This 5-3 structure, this is the absolute fundamental building block of how markets behave, according to Elliott. But here is where the idea gets truly profound. That entire 8-wave cycle we just walked through, it's actually just 2 waves of the next, even bigger pattern. The whole 5-wave advance just becomes wave 1 of a higher degree, and the entire 3-wave correction becomes wave 2 of that same higher degree. This self-repeating quality makes the pattern fractal. The exact same 5-3 structure that might play out over 100 years can also show up on a weekly chart, a daily chart, or even a chart that tracks prices minute by minute. It's wild. Now, Elliott knew that people might start seeing these patterns everywhere, kind of like seeing shapes in the clouds. So to keep the analysis rigorous, he established 3 cardinal rules. These are the non-negotiable laws that a valid wave count absolutely must follow. Okay, rule number 1, wave 2 can never ever fall below the starting point of wave 1. If it does, your count is wrong, start over. Rule number 2, wave 3 is the powerhouse. It can never be the shortest of the 3 advancing waves, waves 1, 3, and 5. A lot of times it's the longest, but it can't be the shortest. And finally, rule number 3, wave 4 cannot dip down into the price range of wave 1. These 3 simple rules provide the core logic for the whole principle. All right, so while the motive waves going up are pretty straightforward, the corrective waves, well, that's where things can get a little tricky. They're basically the result of a tug of war between the main trend and the forces pushing against it, so they can take on some more complex and varied shapes. Elliott found there were basically two main families of corrections. You've got your zigzags, which are these sharp, aggressive moves against the trend, the kind that feel like the market is really in trouble. And then you have flats, which are more of a frustrating, sideways grind, a long, time-consuming pause that really tests your patience. He also noticed a tendency for alternation. If wave 2 was a sharp zigzag, wave 4 would probably be a sideways flat, and the other way around.
So this brings us to the most important question of all. Why? Why on earth would the market follow these specific patterns? Is it some kind of mystical force? Well, Elliott's answer was way more grounded. He said, it's not about magic, it's about the predictable and rhythmic nature of human psychology itself.
The legendary investor Bernard Baruch just put it perfectly. The market doesn't really register events themselves, it registers our human reaction to those events. The news itself is actually less important than the wave of optimism or pessimism it unleashes in the crowd.
And that quote just nails the central idea of this whole theory. That 5-3 pattern isn't just a technical thing on a chart, it's a direct reflection of our collective social mood. Wave 1 is that first flicker of hope. Wave 2 is a dip back into doubt. Wave 3 is that explosion of widespread optimism. Wave 4 is when people start taking profits and getting tired. And Wave 5 is that final, sometimes irrational burst of euphoria, right before the ABC waves of anxiety and pessimism take over again. And this leaves us with a really provocative final thought. The Elliott wave principle suggests that these same patterns that drive stock indexes might also drive the progress and setbacks of human civilization itself. So if these waves really are a map of our shared social mood, understanding where we are in the pattern might just tell us a little something about where we're all headed next.